Why would a property owner voluntarily choose to charge VAT on a commercial building? At first sight, that may appear counterintuitive. Surely it is better to rent or sell a property without adding VAT to the price. However, for commercial landlords, developers and property investors, exemption can create significant hidden costs. The option to tax is not simply an administrative VAT election. Used correctly, it can protect input tax recovery and preserve value. We will examine the principal commercial reasons for opting to tax and the circumstances where it may not be appropriate. The starting point is that many supplies of land and buildings are exempt from VAT. This means that a landlord may grant a lease or an owner may sell a building without charging VAT. That can initially look attractive to the tenant or purchaser because no VAT is added to the price. But exemption creates a serious problem for the property owner. Where the owner makes exempt supplies, the VAT incurred on related costs will not normally be recoverable. VAT on acquisition, refurbishment and legal fees can therefore become an absolute cost. This irrecoverable amount is often referred to as sticking VAT. Exemption may benefit the recipient, but it can impose a substantial financial penalty on the supplier. The most important commercial reason for opting to tax is to unlock input tax recovery. Commercial property projects frequently involve significant VAT expenditure on purchase, construction, and fees. Without an option to tax, some or all of this VAT may be blocked because it relates to exempt income. By opting to tax, the owner converts future rents or sale proceeds into taxable supplies. The related input, VAT, then becomes attributable to taxable business activities and will normally be recoverable. VAT that would be a permanent cost is instead converted into a recoverable cash flow item. The second reason is commercial neutrality. Where a commercial tenant or purchaser is fully VAT registered, the VAT charged may be recoverable by that customer. In those circumstances, VAT does not normally represent an absolute cost to the tenant. It is primarily a cash flow movement. However, this analysis depends heavily on the identity and VAT position of the customer. A bank, insurer, or other exempt organization may be unable to recover the VAT charged, making it a genuine additional cost. The third reason is to protect input tax recovered under the capital goods scheme. Instead of treating input tax recovery as final, the scheme monitors the use of the asset over an extended adjustment period. If a building is subsequently sold exempt during the CGS period, the owner could be required to repay part of the VAT previously recovered. The fourth reason concerns the purchase of a tenanted commercial investment. Where a seller has opted to tax, the sale would normally be subject to VAT unless it qualifies as a TOGC. For TOGC treatment to apply, the purchaser will generally need to make its own option to tax and complete the notification steps. Consider a tenanted commercial property being purchased for £4 million. If TOGC treatment fails, the seller may be required to charge VAT of £800,000. There is also a permanent stamp duty land tax consequence because VAT forms part of the chargeable consideration. Although the option to tax is powerful, it is not suitable in every situation. It may be overridden where a building is intended for use as a dwelling or for a qualifying charitable non-business purpose. A practical option to tax review should address 5 key questions. First, will the building generate taxable rents? Second, are tenants able to recover VAT? Third, is there significant VAT on costs to protect? Fourth, is there CGS exposure to preserve? And fifth, is TOGC treatment required for a tenanted sale? The option to tax should never be left until the week of completion. The first step in the process is to make and formally document the decision, followed by carefully checking for any required HMRC permission and checking for any relevant disapplication provisions. The option to tax is a commercial risk management tool, not simply a VAT form. It commonly makes sense where it unlocks input tax recovery, keeps VAT neutral for taxable customers, protects CGS reclaims, and supports TOGC treatment on the sale. The correct treatment will always depend on the specific building and transaction. Thank you for watching the briefing on the VAT option to tax. If we can be of help, then please do not hesitate to contact the VAT clinic